Trend is your friend or foe? Trends and trend lines are an integral part of technical analysis in the financial markets. A trend is simply the direction in which the price of an asset is moving, while a trend line is a visual representation of that direction, usually plotted on a chart. Trend lines are used by traders to identify the direction of the trend and to make informed decisions about buying or selling the asset. There are three main types of trends: uptrends, downtrends, and sideways trends. An uptrend is characterized by a series of higher highs and higher lows, which means that the price of the asset is consistently moving higher over time. A downtrend, on the other hand, is characterized by a series of lower highs and lower lows, which means that the price is consistently moving lower over time. A sideways trend, also known as a horizontal trend, is when the price of the asset is moving within a narrow range and is not clearly trending upwards or downwards. Trend lines are typically plotted on a chart by connecting two or more price points on the chart. These points are known as swing points and are used to determine the direction of the trend. There are two main types of trend lines: uptrend lines and downtrend lines. An uptrend line is drawn by connecting the swing lows of an uptrend, while a downtrend line is drawn by connecting the swing highs of a downtrend. Trend lines are useful for traders because they can help to identify the direction of the trend and the potential points at which the trend may change. When the price of an asset is trending upwards and is consistently making higher highs and higher lows, traders may look for opportunities to buy the asset. Conversely, when the price is trending downwards and is consistently making lower highs and lower lows, traders may look for opportunities to sell the asset. Trend lines can also be used to identify potential support and resistance levels. Support levels are price points at which the price of an asset is likely to find buying interest, while resistance levels are price points at which the price is likely to find selling pressure. Traders can use trend lines to identify these potential levels and to make informed decisions about buying or selling the asset. There are a few key things to consider when using trend lines in technical analysis. First, it is important to use swing points that are clearly visible on the chart. These swing points should be used to draw the trend line as accurately as possible, as a trend line that is not accurately plotted may not be reliable. Second, it is important to remember that trend lines are not exact and may be subject to change over time. As the price of an asset moves, the trend line may need to be adjusted to reflect the current trend. This is known as adjusting the trend line or redrawing the trend line. Finally, it is important to use trend lines in conjunction with other technical indicators and analysis tools. Trend lines can be a powerful tool for identifying the direction of the trend, but they should not be relied upon exclusively. Instead, they should be used in conjunction with other indicators, such as moving averages and oscillators, to provide a more complete picture of the market. In conclusion, trends and trend lines are an important part of technical analysis in the financial markets. They can help traders to identify the direction of the trend and to make informed decisions about buying or selling an asset. There are three main types of trends: uptrends, downtrends, and sideways trends. Trend lines are used to visual representation of these trends and can be used to identify potential support and resistance levels. It is important to use swing points that are clearly visible on the chart, to remember that trend lines are not exact and may be subject to change over time. Use code BLOG to receive 25% on your next purchase.